Hey everyone, welcome back to the Trade Tea. If you've ever felt like the stock market is speaking a different language, you're not alone. But understanding the vocabulary of the stock market is key to making smart investment decisions. That's why in today's video, we're breaking down 10 stock terms so you can speak the language of the stock market. When you're just starting out, you want to invest with confidence. Knowing these terms will give you the foundation to navigate the market and make informed choices. Let's get started. First up, equities. Think of equities as pieces of a giant pizza. When you buy a slice, you own a part of that pizza. In stock market terms, equities represent ownership in a company. If you own equities, you're essentially a shareholder, meaning you have a stake in that business. As the company grows, so does the value of your slice. Next, we have dividends. Picture this, a company makes profit, and instead of keeping it all, they decide to share some of it with their shareholders as a thank you. That's what dividends are, regular cash payments from companies to their investors. Not all companies pay dividends, but for those that do, it's like receiving a bonus for being a part owner. Now let's talk about stock splits. Imagine you have a $20 bill, and someone exchanges it for two $10 bills. You still have the same amount of money, but now it's in smaller denominations. A stock split works the same way. Companies do this to make their shares more affordable and to attract more investors. If you had one share worth $100 and it splits 2 for 1, you now have two shares worth $50 each. On the flip side, we have the reverse split. It's like exchanging 10 $1 bills for a single $10 bill. Companies use this strategy to consolidate shares and increase the price per share, often to meet stock exchange requirements or improve their image. If you had 10 shares worth $1 each, a 1 for 10 reverse split means you now own one share worth $10. Now, what about shares outstanding? Picture a bakery making cupcakes. The total number of cupcakes they bake is like the shares outstanding. It's the total number of shares a company has issued to investors. Some of those cupcakes might go to individual customers, retail investors. Others to big catering companies, institutional investors. And a few might be kept by the bakery owners themselves, reserved shares. But the grand total of all the cupcakes baked, no matter who gets them, is the shares outstanding. This number is crucial because it impacts key metrics like a company's market value, which is the share price multiplied by the shares outstanding. It's like figuring out how much all the cupcakes together are worth in total. Let's move to initial public offering, or IPO. Imagine a small coffee shop deciding to franchise. To do that, they need funding, so they offer a piece of their business to the public. An initial public offering is when a private company sells shares to the public for the first time, essentially opening its doors to new investors and raising capital to grow. Next is stock index. Think of it as a report card for the stock market. A stock index like the S&P 500 or Dow Jones tracks the performance of a specific group of stocks. It gives you an overview of how the market, or a particular segment of it, is doing without having to analyze individual stocks. Up next, securities. If stocks and bonds sound confusing, just remember they're both types of securities. Think of securities as financial tools or contracts that hold value. Stocks, bonds, and even mutual funds are all securities, like different tools in a toolbox designed for building wealth. Now let's talk growth investing. Picture planting a tiny seed that grows into a massive tree over time. Growth investors look for companies growing rapidly and expected to continue on that trajectory, like Amazon or Apple. The main qualification to be a growth stock is boasting greater and greater earnings each quarter. And finally, value investing. Imagine finding a designer jacket at a thrift store for a fraction of the price. Value investors hunt for stocks that are on sale, companies they believe are undervalued by the market. The idea is to buy low, wait for the market to realize their worth, and then reap the rewards. And there you have it, 10 essential stock terms that will have you speaking the language of the stock market like a pro. If this video helped you, make sure to hit the like button and subscribe for more easy to digest financial content. Got questions or want to suggest topics for our next video? Drop them in the comments below. Until next time, happy investing!